This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading in tight bull channels. I'm going to talk a little bit about scaling in, and I want to talk about the importance of knowing whether or not the bears can make money. This is a 5-minute chart of the euro versus the dollar, and the market's in a tight bull channel for most of the chart. When the market's in a channel, whether or not it's tight, bulls typically take partial profits at new highs, or some bulls take partial profits at new highs, and some bears sell at new highs and above, trying for a scalp. The result is pullbacks are common, and that's why it's a channel and not a breakout. This is a breakout, a series of consecutive bull bars. Once you start getting pullbacks, it's a channel. We're getting pullbacks all the way up, but we continue to go higher. The reason why we get pullbacks is when the market goes above a prior high, the bulls take some profits, take some profits, take some profits, take some profits, and it creates the pullbacks. If the pullbacks are small, the bears cannot make money. And it's important to pay attention to whether or not the bears can make money, because if they can, then experienced traders will start shorting above prior highs looking for scalps. You do not have to do that. In fact, most traders should not do that. When the market's in a tight bull channel, the trend is strong. It's far easier to make money buying pullbacks. Pullbacks are small, usually do not fall far enough for a scalp short, especially selling with a stop below a sell signal bar. Here the pullbacks are all about 10 pips tall, and you need a pullback bigger than that to make a 10 pips profit. Most bears are unwilling to short because it's too difficult to make money. The minimum scalp size for traders is 10 pips, and unless the pullback is significantly greater than 10 pips, it's impossible to make money. And therefore, if you look at a chart and you see that it's very difficult or impossible for bears to make money, even selling with limit orders at the prior high and scaling in, then you should not sell. In fact, that's telling you that the bull trend is very strong, despite all the pullbacks. If the bears cannot make money, the probability is the market's going higher, probably higher for a lot of bars. Therefore, bulls can buy every reversal down, betting that the bears taking the shorts are going to lose. Every bull trend is always forming tops, and typically wedge tops. Wedge tops are very common. However, think about it. We have a wedge top, which is a bull channel, but the channel is tight, and by definition, the channel can only be tight if the pullbacks are small. If the pullbacks are small, betting on a reversal that's big enough to make a profit is a very low probability bet, and therefore a wedge top in a bull trend, if the channel is tight like this, is going to result in a bull flag, and the market will continue higher. Therefore, just because you see a wedge top does not mean the market's going to reverse far enough to make a profit. When the channel is tight and the pullbacks are only 1 bar or 2 bars, you are not going to make money selling. So do not be fooled when you see wedge tops in a strong bull trend. Ignore them. The market will continue higher. Typically, when you have a bull channel, a wedge bull channel, and the market breaks above the top of the bull channel and reverses down, the initial target is a test of the bottom of the channel. When the channel is tight on a 5-minute chart of a Forex market, that is only a pip or two. You need at least 10 pips profit to make any trade worthwhile. Yet, when you have a tight channel, you're not going to get that. Even if the market were to test all the way down to the beginning of the wedge, it still would be difficult to make 10 pips profit. Remember, you're getting a bull breakout above the top of a channel. The target is a test of the bottom of the channel, which is the bull trend line. As soon as the market reverses, you're already at the target, and therefore you should not take that short. Never sell with a stop in a tight bull channel, because you're selling below the high when you're selling with a stop, and the market is almost certainly not going to pull back far enough to get a minimum scalp. When the market looks like this, we're not getting a strong bull breakout with good follow through. We have a small bull bar, a bear bar, 3 small bull bars, 2 bear bars. Some bears will sell at prior highs, use wide stops, and scale in higher, betting that eventually they'll get a pullback deep enough to make a profitable scalp. For me, when the pullbacks are only 1 or 2 bars like this, and the pullbacks are only 5 pips, 4 pips, there's no way that I'm going to sell because the chance of making money is small. But some bears will do it when they see frequent pullbacks like this. They'll sell at the prior high, sell more 10 pips higher, sell more 20 pips higher, and then look to take profits on a pullback to their first entry. When the channel is tight like this, it's probably not going to pull back to your first entry, and therefore you'll get a loss on your first entry. And even if you make a small profit on a higher sell, the combination of your loss and your profit will still result in a loss. Here we got a pullback, we have a pullback, we have a pullback. Some bears therefore will sell at a prior high, betting that maybe we'll get a pullback into a trading range and test the bottom of the range. However, that's still only about 10 pips down, and it's really difficult to make money when your target is only 10 pips below. These bears will sell here and they'll try to sell more 10 pips higher. They might use a wide stop, maybe a 50 pip stop, maybe 5 times the size of a minimum scalp, looking to scale in 10 pips higher, 20 pips higher, 30 pips higher, concluding that if it goes 50 pips higher, their premise is wrong. It's probably not a bull leg in what will become a trading range. It's probably a bull trend. This is a catastrophic stop. Whenever you're using a stop that is wide like this, you're never planning to let the stop get hit. You're just allowing for the possibility that the market may briefly and strongly go against you, but you want time to see if your premise is still valid. If you conclude that it's not valid, then you get out long before your stop gets hit. Let's say you're a bear and you sold this high and you place a limit order to sell more 10 pips higher. Well, this is 10 pips higher. It did not get there, and therefore it's starting to turn down. You did not get to sell more higher, and you're short from here. You needed to pull back below your initial entry price, which is at this high. You get filled right here just to get out break even. So now you're not looking to make a profit on a second entry. You did not get a second entry. Now you're simply hoping to get out, avoiding a loss. The market got near your entry price. I don't know that this dipped below your entry price. In any case, it sold off in 3 legs, 1 pullback, 2 pullback, 3 pullback, and it has a good bull reversal bar. Chances are, if you did sell here, instead of looking to sell more, you're going to get out. You were unable to get out here, or if you were unable to get out here, now you get a wedge bull flag and a higher low. The market's probably going higher, a small pullback bull trend. You have to get out and you have to take the loss. If you sold at this high, you get filled here. And if you exit here above this bull inside bar, you're getting out with a 2 pip loss. This is a good buy signal. It's a wedge bull flag and it's a small bull bar, a bull IOI and a bull trend. This is a buy signal. If you are not short, this is a good place to get long. A triangle, we have 3 pushes down, 1 pullback, 2 pullback, 3. You can simply call it a tight trading range, and it's occurring more than 20 bars into the trend. In fact, it's occurring about 50 bars into the trend. That is late in a trend. Anytime you get a triangle or a tight range late in a bull trend, it's probably going to be the final bull flag. And that means that if you get a rally from there, the market is probably going to reverse back and test the apex of the triangle. Because of that, you'll have some bears selling with limit orders at the high of the triangle and then scaling in, selling more higher. For example, they might sell 10 pips higher, 10 pips is the minimum scalp size, and they're betting that the market's going to come back down to the apex of the triangle, which means below their first entry price. If they sell here and sell more here, the market probably will dip back down below this entry price. They could get out with a break-even trade here and then with a profit here when the market comes back down. The reason why they're selling here is this is a trading range, and they're betting that one of two things will happen. Either the market will turn down and they'll make their 10 pips profit, or it'll go higher, they can scale in, and then it will turn down, and they can get out break even on their first trade and then with a profit on their second trade. And that's what happened. It did not go high enough up for them to add on a second time. However, it did work its way back down to the first entry price at this high. They get filled here and they get out break even. And you can see some buying here. And some of that buying is from bears. The bears are buying to get out break even on the first short at this high. They get filled here and then taking a 10 pips profit on their second high. Other bears, if they take this short, only want to scale in below bear bars. Instead of selling more 10 pips higher, 20 pips higher, what they do is wait for a bear bar closing on its low and then selling more below the bear bar, either here or here. But they want the second entry to be at least as big as a scalp, a minimum scalp above the first entry, so that when it comes back to their first entry, they make a scalp profit, a minimum scalp profit on either of these for their second entry. They're not going to take both, but a lot of bears will take one or the other of these sells. This pullback to their original entry price allowed them to get out break even on their first sell and then with a 10 pips profit on their second sell. Let's say the bears who did sell here used a 50 pip stop and they sold more here. Let's say it kept going up and they sold more here, they sold more here. So they sell more 10 pips above their first entry, 20 pips, 30 pips, 40 pips above their first entry. And let's say it kept going up and it hit their stop. They'd lose 50 pips on their first entry and then a total of 140 pips on all of their entries. How can it possibly be worthwhile to risk that much on a trade? Well, these bears, initially they sold here, hoping it would come down and they'd make a quick 10 pips profit. When it started going up, they were willing to scale in, betting that it would not get much higher before they could get out with a profit on their higher entries. They're not planning on scaling in 5 times and risking 140 pips on their entire position. Most of them will scale in once or twice. They may still use the wide stop, but if it keeps going up, they're going to get out before their wide stop is hit. Can that still result in a positive trader's equation? Well, it can. Whenever you scale into a trade, you increase the probability. However, if you're risking 140 pips to make 10 pips, you need to be right 95% of the time to make money. And that's not going to happen. You're not going to win 95% of the trades. That's not going to happen even with most really good traders. The bears selling more higher are doing so to increase the probability of making money. Whenever you do something to increase your probability, you're going to make your risk-reward ratio worse. Usually what you're doing is increasing your risk. By increasing your position size in a market that's going against you, you are increasing your risk. An expert trader who's selling in a bull trend is only doing it if he can structure a trade that has a positive trader's equation. When I say structuring a trade, I'm talking about creating a plan with several alternatives. And since you're on a 5-minute chart, you have to make quick decisions. And that's just not realistic for a beginner. A beginner, first of all, should never be selling in a bull trend. They should never be selling in a tight bull channel, which is a strong bull trend, and they should never be scaling into shorts in a bull trend. Therefore, beginners should not be doing this. And when the trend has small pullbacks like this, most experts are not going to be doing this either, because the chance of making money is small. It turned out we got a bear trend. However, this is not the short. I would not be shorting here or here. I would wait until I see 3 or 4 bear bars. Here we got 5 bear bars, and then think about shorting. This, I think, is too early. We could go a lot higher before we get a tradable short. The bears who did sell here and looking to scale in higher, 10 pips, 20 pips, 30 pips, 40 pips higher, they're rarely ever going to lose 140 pips. And if you think about it, the market's not likely to go up 50 pips from here after a series of buy climaxes and after a triangle. However, they use a catastrophic stop that allows them to add on to their position. They do not want their stop to be hit, and they know what the probability is if they scale in. They have a high probability of making money. However, they're incurring a lot of risk, and the reward is probably going to be small. Not a particularly good trade. Again, they're not going to let their stop be hit. As soon as they decide the breakout is so strong that it's no longer valid to be selling above bars, they'll get out long before their stop is hit. In general, I'm not going to take this trade because the market is forming gaps. The pullbacks are not falling below the breakout points or only a little bit below. We have another breakout and a pullback. Did not fall below the breakout point. We have another breakout. It's possible that the pullback will not fall below this breakout point, and therefore selling here will be a losing strategy. I usually do not sell with limit orders until I see the bears making money selling with limit orders, and then I'll start doing that. In the strategy of selling in a bull trend and scaling in higher, you have a lot of winners and losers that are only 10, 20, or 30 pips. If you are very good at this, it's a profitable strategy. As I said, it's a terrible strategy if the market's forming gaps. You need pullbacks to be falling below breakout points, and until they are, selling above highs and selling more higher is a losing strategy. In this particular case, it turned out to be profitable, and for the bears who sold at this high, they got filled here. If they sold more 10 pips higher, 20 pips higher, 30 pips higher, it ultimately came back below this high. They'd get out break even on the first entry and with a profit on their higher entries. So yes, it turned out to be a profitable strategy, but in general, traders should not be trading strategies that require winning 80 or 90% of the time. It's just too difficult to do successfully long term. Plus, it's not all that fun. It makes more sense to be buying pullbacks than selling rallies when the market's in a tight bull channel, and that's a lot more fun. This is a very tight channel. However, if the channel is very broad, an expert trader can win 90% of the time selling at prior highs and scaling in higher. The average win in a broad channel might be 30 pips, and therefore if he takes 10 trades and he has 9 wins 90% of the time, times an average profit of 30 pips, he makes 270 pips total profit. If he has one loss where he loses the full scaled in position for 140 pips, it's still profitable. He won 270 pips. He lost 140 pips on one of his 10 trades, and that's still a profitable strategy. Again, I'm talking about a broad bull channel. You have to bet that the chance of losing the full 140 pips, in other words, having it go up 50 pips above your first entry, is small. In a tight bull channel like this, the bears quickly get disappointed and they try to get out break even, or they're not going to scale in more than once or twice because they know the rally is too strong. So you sell this high and then you see 3, 4 consecutive bull bars. You might sell more higher, but if it doesn't quickly start to go sideways or down, you're going to try to get out even if it means getting out with a loss. Tight bull channel, do not sell. When the channel is tight like this, it's hard to make more than 10 pips profit. Here, the bears were lucky. They got a big reversal. It fell about 50 pips, but this is the exception. Usually the market will just go sideways for the rest of the day, the rest of the session. As I said, because tight bull channels usually do not pull back very far, they usually go more sideways than down. Even if you win 90% of the time, you're barely going to make money. You'll be adding on to positions multiple times and then making 10 pips while risking 50 pips, 100 pips, 150 pips. It's a terrible strategy. The alternative is to buy, and that's what you should be doing whenever the channel is tight like this. You have a tight bull channel, do not think about selling. Just look to buy constantly until you start to get 3 or 4 consecutive bear bars, 4 or 5 consecutive bear bars. Then the idea of a very tight bull channel is no longer valid. You change your strategy. I always pay a lot of attention in a bull trend to whether or not the bears can make money. Because if the bears can make money fairly easily, the bull trend probably is transitioning into a trading range. Let's say a bear sold at this high, they get filled here, and they lose money here. Let's say they try again. They sell at a new high, so they sell with a limit order at this high, and they get filled here. It continued up, and it did not pull back far enough for them to make money, did not pull back far enough for them to even avoid a loss. They did lose, and they'll have to buy back their short as the bull trend is resuming. We have a double bottom bull flag and a strong bull trend. So the limit order bears lost money again. Do you think it's a good strategy to be selling? The limit order bears selling at this high lost money. The limit order bears who sold at this high lost money. It's a terrible strategy to be selling at the highs at that point. The bears see how hard it is to make money selling above the last 2 highs, and therefore they're going to conclude the bulls are strong, and most of those bears are not going to be selling at this high, even though this is a potential final bull flag. They want to see the market evolve into a trading range or at least a stairs pattern. They want pullbacks to fall below prior highs before they're starting to sell. The smart bulls pay attention to how easy it is for the bears to make money. And when they see the bears being forced to exit with a loss here and again here, the bulls are confident that the market's going high enough up for at least a profitable long. And the bulls who are long for any reason, therefore, are more willing to hold on to their long for a swing trade, and the bulls who are flat are more willing to buy. Some bears, when they see the bull flag, and if they short here, will reverse to long, a high 2 bull flag and a strong bull trend, betting that they'll recoup their losses on the reversal up. Most traders do not like to reverse, and instead they just get out of their losing short. For the bulls, they know the bears will get out, and the bulls will buy where the bears are getting out. That's one of the reasons why high 2 bull flags and wedge bull flags are so profitable. The bears give up, and they're not going to sell again for at least several bars. The biggest bull bar in more than 20 bars. The biggest bull bar late in a bull trend. It's a bull breakout above the bull channel. 75% chance a bull breakout above a bull channel will fail, and the market will either reverse or go sideways. So a buy climax at the top of the channel. The bears believe the market's probably going sideways, maybe down. Here it went sideways, and that worked off the extreme buying, the exhausted bulls. The bulls wait a few bars, 5 or 10 bars, a couple legs, 1 pullback, 2, to see if the bears can get a successful reversal. Once they conclude that the bears have had a lot of time to reverse the market, and they've had 2 legs down, 1 pullback, 2, and they have not been able to reverse the market, they're going to buy again. The bulls are going to buy, expecting another leg up. A buy climax, theoretically a reasonable sell below that bear bar. If you have a reasonable sell and you scale in and use a wide stop, you're usually able to avoid a loss, and in fact, you're usually able to make a profit. However, rather than selling below this bar and selling more 10 pips higher, 20 pips higher, and holding on for 30 or 40 bars, I still think it's better only to buy until the bears start to get 3 or more consecutive bear bars. Some bears will either sell below this bear bar, expecting that whatever rally we get will come back to that low, or they'll start selling breakout points above prior highs and selling more higher. If they take that sell, a reasonable stop is a little bit more than some kind of a measured move. One measured move choice would be the height of the final buy climax. We have buy climaxes here, here, here. A lot of bears, if they take this short, will put a stop just above the measured move up based upon the height of this buy climax, and then scale into shorts as the market goes up. Again, not a great trade. The bears have not made money in 50 or 60 bars, and therefore selling, for me, is too early. I want to see the bears make money before I start selling. Some of these bears, instead of selling 10 pips higher, 20 pips higher, will look for a bear bar and then sell below the bear bar, either here or here, as long as the second entry is at least as big as a minimum scalp above the first entry. Minimum scalp in the Forex market is 10 pips. If selling below this bear bar is selling at least 10 pips above their first entry, it's a reasonable sell, betting that the market will come back down to their first sell. Once it did, the bears who did sell here get out break even on this sell, and they get out with a profit up here. Some bears do not take that sell. They just wait for the bear bar, and once they see it, they sell below it, betting that the market's going to come back here. Other bears, instead of taking this sell and that sell, will wait for a second entry sell, and if it's at least the size of a scalp above this first sell, that prior high, then they'll sell here. This is a higher probability short, looking for a pullback below this high, the breakout point. Bulls, they're paying attention to whether or not the bears can make money, selling at prior highs. The bears are not making money. And at some point, they give up and they stop trying. Well, we know bears who sold these highs, if they used a very wide stop and scaled in, were able to make money. The market eventually sold off below this high and below that high and below this high. However, as I said, while you might be able to structure a profitable strategy, the trader's equation is terrible compared to the trader's equation that the bulls have buying for any reason, buying below bars, buying above bars, buying breakouts to new highs. And when a channel is tight like this, it's far easier to make money buying. Bull breakout and follow through. Bull breakout above this high and good follow through buying. If a bear did take this short and he sees the bull breakout bar here and follow through bar, an alternative is just get out on the follow through bar. Let's say a bear sold this high and he sees a bull breakout bar that looks strong, just get out, or if possible, reverse to long. But as I said, even most experts do not reverse. Therefore, it's unrealistic to say, oh, just get out of your short and reverse to long and you'll make up for your loss. Real world, it's not going to happen. You're not going to do that. Most traders will just simply take the loss and step aside. If you're looking to get long after you see the bull breakout and follow through, it's usually better to wait 1, 2, or 3 bars until emotionally you feel stable, and then you can start thinking about buying. You were selling here, it's just hard to suddenly think, okay, selling is bad, I'm going to buy. Usually you have to wait 1, 2, or 3 bars after you get out and then look for a buy. So had you sold here and you get out here, you might buy above here, a small high 2, high 1, high 2, or you might wait to buy above a bull bar, like over here, 2 legs sideways to down, 1 pullback 2 after a buy climax. If you're reversing, let's say you sell here and you reverse to long here, you have to do it perfectly. It's unrealistic. It's very difficult to do, very difficult to do emotionally. If you're thinking short, 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 it's hard to suddenly think buy, buy, buy. Therefore, even though on paper you can look at it and it makes sense, you sell, no, you switch to long, you reverse to long, and then you get out here with a win that more than offsets your loss. Unrealistic. It's far better not to be shorting when the channel is tight and only look to buy. Very easy to have emotions interfere with your ability to execute properly. So if you sell thinking that, well, if it goes up, I'll reverse to long, you won't do it. When the time comes to reverse to long, you will not take the trade. You'll be confused, you'll be upset, you'll make mistakes, and you'll end up taking a loss on your short. And if you do go long, you'll then be confused by the market not going up, and you'll probably get out here taking a loss on your long. Whenever it's really hard to make money doing something, it's usually better to do the opposite. All of these sell signals, if you think about it, if you were to take the opposite, do the opposite, and buy every time you think sell, you're probably going to make money. And that's usually the case. Whenever it's hard to make money doing something, it's usually easy to make money doing the opposite. So instead of taking all of these sells, it's far better instead to be looking to buy. So don't take those sells, only buy. I began by talking about scaling into shorts in a tight bull channel, and I said, do not do it. It's a losing strategy. If all you're doing is looking to short, you're going to be losing money, and you are not making the easy money, which is buying. Whenever you're in a tight bull channel, you should be buying for any reason. It's really important to pay attention to whether or not the bears can make money. If it's very difficult for the bears to make money, then it's probably pretty easy for the bulls to make money, and therefore you should be looking to buy for any reason. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading in tight bull channels.